Welcome to this August 2023 edition of Economic Impact. Today, we have many subjects. First of all, we're going to talk about stock performance. Once again, we're going to talk about inflation. We're going to talk also about inverted yield curve. And at the end, the real estate in Canada. Stéfane, can you talk a little bit about the stock performance, especially beginning August? It's not that great.
Not great. It's still early in the month, Denis, but everyone is down. Every stock market, major indices are down. The quarter's still positive, Denis, but certainly not barely, and certainly not as strong as what we saw in previous quarters.
But still pretty good since the beginning of the year.
You're right. If you look at it from a year-to-date perspective, it's up more than 10% globally. Every region of the world is showing positive returns. And I think part of that is due to the fact that despite, rate hikes, we still had a few this summer. The good news is on the inflation front, it's coming down relatively quickly. And for both Canada and US now being at below 3%.
Surprisingly quick.
It's true. Yeah. It's surprisingly faster than we expected. And obviously, Denis, the expectations now is that maybe the central banks will stop with the tightening cycle.
Okay, but with the inflation going down that fast, why the stock market is not showing sign of better sign than what we're seeing so far?
Expectations of a soft landing, Denis, and expectations that rate cuts are not too far down the road, and I doubt they will happen this year. And
is it because the yield curve is so inverted that now the stock market are taking that into account?
Well, the issue right now from a valuation perspective in the U.S., if you look at the S&P 500 trading at 20 times forward earnings with an inverted yield curve, that's never been observed in the past. So it's the highest valuations. So
uncharted territory right now.
Uncharted territory, and people are saying, well, if the Fed can cut rates quickly because inflation is coming down, therefore we will achieve a soft landing for the economy.
Which is rare.
It's not impossible, Denis, but yes, it doesn't happen very often. So we are now in the midst of the 11th episode since the mid-1960s where the yield curve is inverted. 8 of the previous 10 episodes turned out to be recessions. So it is not abnormal for the economy to continue to grow 9 months after an inversion, but we're getting into challenging territories. The only 2 exceptions that we've seen in the past where you had an inverted yield curve without a recession was the mid-1960s and the late 1990s. So
it's been a while.
It's been a while, and also it doesn't happen very often, so it remains to be seen whether a soft landing can be achieved. Again, a soft landing is the exception, not the norm, and so far the market has said, well, with inflation coming down, mission accomplished, we will get a soft landing.
Okay, but at the same time that we're seeing the inflation going down that fast, probably what we're seeing is the easy part of the inflation, that we're losing. But at the same time, the salaries inflation in the U.S. market and the U.S. economy is quite high.
Yeah, so the base effects are unwinding for overall CPI, but the issue from the Fed's perspective is how quickly can I cut interest rates when wage inflation is growing at 5%, which is twice the inflation rate that we saw prior to the pandemic. So basically, maybe they're done with rate cuts, Denis, but I can't promise you with rate hikes. But I can't promise you rate cuts this summer. Definitely not with inflation, wage inflation growing at that speed.
And if you add all the geopolitical that we're seeing right now, that seems that we have an intensity. What's going on in Ukraine and in Russia once again.
That's not helping because the issue is now we know that grain shipments from Ukraine have been stopped or certainly curtailed. And at the same time, Ukraine is starting to attack Russian energy infrastructure. So you have a situation where both food and energy prices might remain resilient, limiting the ability of central banks to cut rates. So the geopolitical backdrop, you're absolutely right. That's part of the equation and makes it a little bit more complicated to cut rates quickly.
Okay. Those are variables that we may keep the inflation high, but at the same time, we're seeing factory in the state that production is kind of low. compared to what we used to see?
So the impacts of previous rate hikes is clearly apparent on the global economy, and this is why manufacturing production is being cut down, being reduced, and it's impacting China. Denis, it will also impact earnings. So the issue at this point in time, can profits rebound quickly in an environment where the economy continues to slow? So that's the big challenge from an equity market perspective. And it's certainly a challenge to achieve a soft landing if the central banks cannot cut rates at the time where inflation is sticky because of geopolitical factors, tight labor markets, and at the same time, the impact of previous rate hikes is becoming
Then,
much
at your
apparent.
point of view, are we delaying the rate cuts further in 2024 instead of, let's say, mid 24? Maybe you're seeing that postponing because of those variables that are inflationary?
That's the risk, Denis, and that's part of the reason why we've seen a backup in long-term interest rates this summer. The reality is the market was expecting rate cuts this summer, or just a few weeks ago, they were expecting rate cuts by the end of this year. It's unlikely to happen. Now the market says early next year. It might be delayed till the second quarter of next year, Denis. So hence, the probability of a soft landing must be reassessed under these scenarios. So again, a complicated backdrop.
And even more complicated for the Bank of Canada because of the real estate situation, the demography in Canada.
So we all have challenges. So from a U.S. perspective, wage inflation is an issue. From a Canadian perspective, it's surging population growth, which puts upward pressure on anything related to housing costs, which is a big component of the CPI. So it gives you a sense of what's happening in Canada right now. As the population is growing at the working age population, Denis, that is growing at roughly 240,000 people per quarter.
That's massive.
It's 3 times the historical norm. And housing starts just can't keep up. We would need 140,000 starts per quarter to accommodate this population.
We don't have the infrastructure to do that. Not enough workers, not enough machinery, and it's impossible.
No, plus it's, we're in the midst of the most aggressive tightening cycle in over a generation. So these are interest rate sensitive sectors. So again, the issue is that the federal government has increased the immigration quota at a bizarre time when you consider that we're in the midst of a very aggressive tightening cycle. So we just can't accommodate the population influx. To give you a sense, normally we have 0.6 home starts per population growth. We're at only half that level right now, 0.3. Every province is suffering. PEI, the smallest province, they have 10 people per home starts right now. This is such a low ratio, and every province is feeling the impact of this. So what that means, Denis, from a Bank of Canada standpoint, given the population surge, which is unprecedented, anything related to housing is inflationary. So it's good if you're a homeowner because home prices will continue to trend up. But from a Bank of Canada standpoint, like the Fed, you can't cut rates relatively quickly.
And down the road, that means that there will be probably a social cost attached to that. Then the government of Canada will have to come with some solution down the road.
Politically, we have to find a solution because, currently we have working age population growing at roughly 1 million per year right now, which is unprecedented, and we just can't.
But we need immigration, but not at that rate.
You're absolutely right, and we've always been a big proponents of immigration.
You and me, by the way.
Yeah, but absolutely. So, the government says 500,000, but right now it's 1 million. So that doesn't work, right? So I think 300,000 to 500,000 is where we should be from a Canadian standpoint.
Which is pretty big when you compare to other countries.
It's massively big, but right now it's way too big.
Then a lot of variables, not enough equation to find a solution. Then the name of the game is being prudent here.
Oh, listen, we don't know how the scenario will unfold in the coming quarters. There's more uncertainty. If you can't cut rates quickly, you have to reassess your outlook for profit growth and multiple expansion. So again, we recommend being more prudent going through the second half of this year. And let's see what happens. This is a cycle for the record books. And the probability of soft landing still exists, Denis. But I don't know that it should be the baseline scenario at this point in time. The next few weeks will be very, very telling.
Well, thank you, Stéfane, for all those info. Hopefully, it's helping you in your investment process. We'll see you next September. Thank you very much for joining us.